Good afternoon, everyone. My name is Michael Kimmel, and I am RPB's Executive Director, and I'm very happy to welcome you to RPB's Fall 2018 installment of our quarterly webinar series. We're thrilled to have over 160 participants registered for today's webinar with a focus on retirement readiness. In addition to myself and Len Teitelbaum, who is chair of our board, we have with us David Baskin, who is chair of our investment committee and president and founder of Baskin Wealth Management, and Stephanie Berger, RPB's director of marketing and communications. Before I turn it over to Len, who will review the agenda and provide some opening remarks, a few housekeeping items. As always, this webinar is being recorded and will be posted to our website in a few days. We will also email a link to you. You can submit your questions anytime by clicking on the Q&A button found at the bottom of the screen. We have allotted time at the end and hope to be able to address them all then. Len, the floor is all yours.
Bogadow. Today our agenda is a bit different. Our webinars in the past have centered on the many enhancements we've introduced over the last 2 to 3 years to your plan. Excuse me. This, of course, is after a commentary on the markets in our plan by David Baskin, previously known as chair of your investment committee, and at times supplemented by our outside investment advisor, Summit Strategies. Today, after our market discussion led by David, we will examine the most asked question posed to anyone managing individual retirement funds. While phrased in many ways, it basically boils down to, am I ready for retirement? The objective today is to show you how you can better answer that question. For those on the call who are already taking distributions, there will also be some useful tips for you. As a side note, I managed individual funds for a major bank here in New York for 14 years, beginning in 1965. I'm pleased to note that there are attendees on this call who were not born in 1965, and that does not do well for my ego. And although the names of the clients have certainly changed, the basic question remains the same. Am I ready? Now, if we meet our objective today, you'll have a better understanding of the steps that you can take to be retirement ready. Michael Kimmel, our executive director, has proven invaluable in assembling the data and will lead with the assistance of Stephanie this discussion. But I'm sure David and I will have some interjections. I would like to thank Stephanie, again, our Director of Communications and Marketing, for her invaluable assistance in helping to prepare this webinar. David, will you start a market presentation, please?
Thank you, Leonard, and welcome everybody. As chair of the RPB's investment committee, it's my job to help the board understand how we're doing with our various funds that our participants have entrusted us with. 2018 has been a very interesting year, perhaps never more interesting than in the last 3 weeks. And for those of you who follow the market, of course, you will have noted that yesterday was a particularly volatile day. With the NASDAQ, the high-tech index, falling over 4%, and most of the gains in the American stock market for the year to 2018 evaporating. This is in sharp contrast to the results for the first 9 months of the year, which were quite strong. I want to say that it's not unusual for markets to go through this kind of correction or downdraft after they've had a particularly strong period. And that's certainly what we experienced in the third calendar quarter of 2018. Very strong markets, particularly in the United States. So I don't want anybody listening on this call to be overly discouraged by what happened yesterday or what's happened in the past 3 weeks, and I'll explain why. The important thing, in my view, to understand about the American economy right now is that corporate profits are at record highs and are expected to continue strong growth both for the remainder of 2018 and also for 2019. Ultimately, stock market returns are driven by corporate profits. And when we see strong profits, therefore, we expect the stock markets to be worthwhile investments. Unemployment in the United States is at a 50-year low, but at the same time, the number of Americans as a percentage of the population who are engaged in the labor force has not yet reached the numbers of 10 years ago prior to the Great Recession. Profits, as I've said, are at a record high, but at the same time, those who benefit from those profits are an increasingly small part of the American population as wealth and income become more unevenly distributed, with greater shares going to the very wealthy, and therefore stock ownership being concentrated in a smaller number of hands. Although we've seen terrific corporate profits, and so far the results that we've seen for the third quarter have been very strong, there are some signs of weakness and some worrying trends. And I think what we saw yesterday and what we've seen in the month of October is in part a reflection of these worrying trends. I would refer specifically to trade tensions. The United States has unilaterally decided to engage in trade warfare against its largest trading partners, being Canada and China. The imposition of tariffs on steel and aluminum led the chairman of Ford Motors to claim that that company lost $1 billion because of trade tariffs. We're seeing the effect also in lower prices at the farm gate for various crops, particularly those usually destined for China. We're seeing interest rate increases. The Federal Reserve Bank has declared that it will bring interest rates from an accommodative policy back towards a neutral policy, and it believes that it will have to raise rates probably at least another 1 full percentage point to reach neutral. When interest rates go up, bonds become relatively more attractive to investors and stocks become relatively less attractive. Finally, much of the market leadership, not only in the United States, but also in the world, has been from a small number of very large technology companies, the names of which are, of course, familiar to all of you. And I refer to Facebook and Apple and Google and Netflix, Microsoft, which reported stunning earnings today, and a few other. Those companies have, of course, done very well, and we know that the first two companies worth $1 trillion surfaced this year as a result of the growth in market capitalization of those companies. Those were the names that were hit most badly yesterday. Again, a natural thing after they've gone up so much. Finally, of course, as Americans, you're all familiar with your midterm elections, which are coming up quite quickly, and I may say those of us in Canada are watching with something between interest and horror, and only hope for the best. Stephanie, could I have the next slide, please? So this shows you the volatility of the S&P 500 over the last 23 years. The thing to look at on this chart is 2016 and 2017, when there was essentially very little volatility and very little downside, no downside months. And until October, really no downside months in 2018 either. All of a sudden, that trend is changing. Volatility is returning, but the thing to note is that it's returning to normal. It's not abnormal to see this kind of ups and downs in the market. Next slide, please. We always, every quarter, like to show you what we call the quilt, the returns on various classes of assets by year. In 2017, emerging markets were the superstars of investment, returning 37% to investors measured in American dollars. So far in 2018, the emerging markets are the worst performers. This year, until September 30th, the American large cap equities, the giant companies, were the best markets in the world. As you can see from the chart, in 2015, 16, and 17, they were just middling. The point of this chart is to show you that diversification is essential in every portfolio. It's impossible to know what asset class will be the leading performer in a given year. Therefore, we must be invested in a number of them. Next slide, please, Stephanie. Over long periods of time, stocks that we think of as value stocks, those that trade at a low multiple of earnings, that typically pay dividends, that are typically in stable industries, have tended to outperform growth stocks. But over the last 10 years, we haven't seen that. We've seen the growth stocks, the Amazons, the Apples, the Googles, and the Netflix outperform the Johnson & Johnsons and the General Motors. You can see that in this chart. The green numbers indicate periods in which growth has outperformed value, and it's not just in the United States, it's in not only Europe, which is the EFI, but also in the emerging markets. Over the 1, 3, 5, and 10-year periods, growth has been the winning strategy. Over 20 years, value still has an edge. The investment committee believes that we will see a reversion to the normal pattern sometime soon. We don't know when. It's possible that yesterday was the harbinger of that return to the norm, when we saw growth stocks take it on the chin and value stocks perform relatively better. The point of this chart is that your committee has taken the decision to adjust its asset mix out of growth, essentially taking profits on the very strong performance in growth, and take some of that money and put it on the sidelines, and take other of that money and put it into value stocks. Yesterday and this month, that has turned out to be a very profitable strategy indeed. Next slide, please. One of the things that the Federal Reserve Bank is concerned about is inflation. We haven't really had significant inflation in the American, or indeed the world economy, for about 20 years. We had a small spike in inflation prior to the stock market crash of 2008. But really, if you look at the chart on the left, you will see that for 20 years, inflation has been in the 2.5% to 3.5% range. The upward pointing gold arrow is what has the Federal Reserve worried. I can tell you that myself, I'm not particularly worried about inflation, not as much as the Fed is. But in terms of retirement readiness, inflation is the great destroyer of wealth for those who have a fixed income. Those of us who are old enough to remember the periods between 1974 and 1982, when inflation in the United States peaked at 13% a year, know how devastating inflation can be. The Fed is certainly being prudent in worrying about inflation. Whether they will turn out to be too cautious remains to be seen. Next slide, please. As those on the call know, we now offer managed products, which we call Tier 1. This is our Capital Appreciation Fund, our Appreciation and Income Fund, our Income Focused Fund, and our Capital Preservation Fund. These are actively managed by the Investment Committee with the help of its professional managers. For the 9 months through September 30th, the Capital Appreciation Fund somewhat underperformed its benchmark, and in part, this was because of our bias towards value rather than growth. I can tell you that in the month of October, although I haven't seen the numbers, I'm pretty sure we've outperformed our index by a substantial margin. The Appreciation and Income Fund, which blends the capital appreciation product with fixed incomes, that's bonds and bond proxies, has handily outperformed its benchmark. This is partly because of some diversifiers that we put into that mix in a low yield environment to goose performance. The Income Focused Fund has a meager return of 0.5%. As interest rates rise, bond prices fall. The fact that we've eked out a positive performance in the face of a 1.6% decline in the benchmark is noteworthy. And finally, the Capital Preservation Fund, our absolute safe product, don't lose money under any conditions, has managed a 1.4% return, which I have to tell you looks not so bad today. The other thing that we offer now is Tier 2. Stephanie, if I could have the last slide, please. Tier 2, I'm sorry, we have the volatility slide. In the interest of time, I'm going to skip that today, Stephanie, and go right to Tier 2. So Tier 2 are passive products with super low management expenses, which are designed to mirror various indices. The one on the far left mirrors the S&P 500 index, which is not a bad performance. The one beside it in blue mirrors the US small cap index. Most of the other products are various fixed income components, except for the foreign markets. As you can see, the foreign markets, the orange one, which is the developed world market, is negative, largely because of strong performance by the US dollar. The emerging market product, which is pale yellow, minus 8.8%. As I noted, emerging markets have done very poorly this year. The other ones are around the zero mark. They're fixed income products. Finally, I would note the Reform Jewish Values Initiative, the very far right-hand corner, with a 3.8% return. This is matching the benchmark, which is the All World Index. So, ladies and gentlemen, what I would say is this. Our performance for the first 9 months of the year was pretty good. Our performance for the first 9 months plus 25 days of the year probably is considerably less good, particularly in the Capital Appreciation Fund. My own view is that corporate earnings ultimately drive stock prices. We think corporate earnings will come through very strong in the current quarter, and that we will see a recovery in the stock indices going into the end of the year, leading to a mildly positive return for the Capital Appreciation Fund, as well as the Appreciation Plus Income Fund. And if we manage to make 1 or 2% on bonds this year, I think that will be, relatively speaking, a triumph. And that's the end of my remarks.
Thank you, David. This is Michael again. We're now going to turn to the main portion of our webinar for this afternoon, which is a focus on retirement. One universal question about retirement planning is, am I saving enough for retirement? And of course, if you're already retired, will my savings last? Allocating a lifetime of financial resources to support a satisfactory standard of living in retirement is one of the biggest challenges we face. For the remainder of our webinar today, we're going to discuss what retirement planning means today. We're going to review some retirement readiness scenarios. We're also going to go through some changes that you can make with a focus on our active participants, although we do have some recommendations for our retirees as well. And then what you might do next. With that very brief introduction, I'll turn it over to Stephanie.
Hi. To kick off this part of the webinar, we're going to talk to you about 4 key trends that are important to consider in your planning for retirement. First is that retirement no longer means that you've stopped working. More than likely, most of you will continue some type of work, either part-time or some type of brand new venture, once you've, quote, retired from where you've been working for the prior 30 years. We're also living longer, which means we'll be spending more time retired. This will be a key factor in your retirement planning process, as longevity calculations are a major factor in how your income will last, how long your income will last. Healthcare costs are another component of your retirement budget, and these are rising. And lastly, there's a focus on whether people will have adequate income in retirement to maintain the standard of living they experienced before retirement. So let's see how these trends relate to thinking about your readiness. So in this slide, you see 3 boxes. The middle box is yet another question: how much of my income will I need in retirement? You'll need to consider, in order to answer this question, 2 things. One is the multiple sources of income that you will be using and drawing on in retirement. So this is not just looking at your retirement savings, but looking at everything from your own personal savings, your tax-deferred and tax-advantage accounts, Social Security, any real assets you have, and as we spoke about just previously, any money you may get from working while, quote, retired. Also, you'll want to consider the factors that you have in control to improve your standard of living in retirement. These include how much you make, how much contributions you make to your plan, when you decide to retire, when you decide to take your Social Security, how much you'll be spending in retirement, and what your asset allocation is as you're saving. So the key point to take away from this slide is that this question, how much of my income will I need in retirement, translates into something called an income replacement ratio that Michael will talk more about, and that you do have some control over how to increase this ratio.
Thank you, Stephanie. So we're just going to take a few minutes to talk about the income replacement ratio. What this really means is the percentage of your pre-retirement income that will enable you to maintain the same or similar standard of living in retirement. Typically, and in the chart you see here, typically consists for many of you of your retirement savings plus Social Security, but as you saw from the previous slide, it might also include other sources. This is simply a rule of thumb and a starting point for thinking about your retirement. As we said, the rule of thumb is about 80%, but it may be higher or lower depending upon your circumstances. The chart on the right does a little bit of a comparison between what a typical American utilizes or considers as its sources, as their source for retirement income, whereas you have, approximately 30% of that 80% coming from Social Security and the balance coming from retirement savings. For us at the RPB, that ratio may look a little bit different, but again, every situation is different. And the reason we consider or looked at Social Security be less of a source as a percentage of the total is because on average, our participants earn more than the average American. So as you earn more, Social Security, which is more or less fixed or it caps out, will replace less as a percentage of total. Now, why not 100%? Retirement budgets change over time, and they pass from the go-go years to the slow-go years to the no-go years. I like that, Stephanie. Stephanie came up with that one. Some things obviously to consider. When you first retire, avoid overspending. I'm sure many of you are anxious to go start traveling and start living or living differently than you're currently living. But, you might want to take it just a little bit slow as you ease into retirement or into your next phase of your earning or non-earning years as they may be. Of course, some spending categories will slowly decline, some essentials, discretionary expenditures, direct working expenses like commutation, dry cleaning, and other things like that, while other categories may rise. Traveling, healthcare, of course, Stephanie mentioned, and what we've been told by our retired participants and what the industry experts do say is that things will come and go. Expenses might go up a little bit, they may go down a little bit later on in retirement and then transition up. So this is just a little bit of an introduction to what we mean by income replacement ratio. And now what we're going to look at is what your retirement paycheck may look like in retirement compared to what it might look like before retirement. So this is just a model person, it's not a real person, whose pre-retirement gross income is $129,000 on an annualized basis. And you can see here, we modeled this out so that In fact, approximately 20% of that 80% comes from Social Security, and the rest comes from what we're assuming to be withdrawals from your RPB account, or your retirement savings account. We have a number of assumptions that we built in, which you can review here. Now we're going to transition into what might some of those adjustments be on an annual basis. This particular individual is a rabbi, or could be a cantor, and we're assuming that the parsonage that this person had pre-retirement continues in retirement. Again, very dependent on the individual. Some people will pay off their mortgage so that their parsonage may go down. Other people will continue carrying a mortgage. I've spoken to many people who have done both. The elective deferral retirement contribution. This particular model person is contributing 3%. Now, of course, when they retire, that contribution will go down. So that will adjust their taxable income. Now for what it looks like for the bottom line. On a monthly basis, on pre-retirement versus in retirement. Two things to point out. I know there's a lot of numbers on the chart. The two things that are major changes. One, besides not paying into your retirement plan any longer and not paying into Social Security, you're not collecting from those sources. So you can see that the negative $1,483 goes away, which is your Social Security and Medicare tax, and now you're collecting approximately $2,100 of Social Security income. So you could see that in this model example, the bottom line take-home pay, or your paycheck, if you will, doesn't really change all that much. Now, of course, this is very illustrative. There are a lot of assumptions that were built into it that are really going to be very different based on where you live, what your tax rates are, what other taxable income you might have that could affect what this looks like. But we really wanted to present this as a way to illustrate what pre-retirement and in retirement might look like, or may look like. And again,
if I could just add, Michael, because what strikes me best about this chart, which has been around for a while but has been very illustrative for pre-retirees, is I write a check on what I put in my checking account every month. How close to that number can I become? And we're replacing 80% of the gross. Michael has listed the assumptions. We want to emphasize this will change person to person, but this is a fair representative of this particular cohort. We get to a number that is very close to what we had before. And that's, I think, one of the comfort levels of trying to look at numbers this way.
Thank you, Larry. Now we're going to look at the impact of saving and retirement choices that you have while you're still working and how they might affect your annual paycheck in retirement. Examining these choices and trade-offs will give you practical guidance to help you be, hopefully, retirement ready. So we're going to look at three different scenarios. We looked at their projected income replacement ratio currently, and then based on which incorporates their current contributions, their earnings, and their retirement age, and how they might be improved by different strategies. For example, increasing contributions and or delaying retirement. Very, very interesting information. Just a couple of things to note. We do not incorporate any outside assets because we really don't know what they may be. If you have spousal income and how that might be contributing to your overall household retirement situation. We only know what we know about you. We were able to make an assumption on Social Security, but that was pretty much it. So let's look at the first person. First let's review the assumptions that were used that were incorporated into the model, and we did. First, we only looked at active participants. We assumed their retirement age is 67 years old and that they live 25 years in retirement. So what that means is if you retire at 68, you'll have 24 years in retirement, et cetera. The income replacement ratio target, which we talked about, is 80%, that the person draws at their full Social Security age of 67, and that the benefit is 75% of the maximum benefit at full retirement age. There are literally dollar maximums based on your earnings history, your Social Security earnings history. We assumed 75% of that maximum to be just a little bit conservative. We assumed annualized inflation, or COLA, which stands for cost of living adjustments, of 2%, and an annual salary increase of 3%. Lastly, the investment returns were based on our outside investment consultants' market assumptions over 3 time periods, for the next 10 years, for the 10 years after that, and the 10 years after that. And it's way too much to go over in this presentation. We will include that chart in the PowerPoint that we post on our website. Okay, now, participant number 1. Person is 45 years old, has a saving horizon of 37 years, as this individual joined the RPB at the age of 30, has approximately $330,000 in their account, and notably, their contributions are as follows: 15% from the employer and 0 from the employee. When we model this out, and again, this is just based on a model, we project that their income replacement ratio will be 63.7%. Now, how do I interpret that? How do we interpret that? What that basically means is that this individual won't be able to live 100 or 80, but 63.7% over a 25-year time horizon. We also assume, and you'll see this in the following slides, that participants claim Social Security, as we said, upon retirement, and if they delay retirement, their Social Security will also be delayed. And it's very important to know with Social Security that as you delay, you get more. In fact, when you go from full retirement age at 67, if you delay to 70, you get an 8% raise for those years that you delay. Now, let's see what happens if this individual makes some decisions about how they might change their situation. This individual now shows that they're contributing, instead of 0% employee contributions, contributing 2%. Now, what does our model tell us? The model tells us that the balance at retirement grows by $252,000, and their projected income replacement ratio improves almost to 68%. Pretty good. Now what happens at a 4% increase, percentage point increase in their contributions? Jumps to almost 72%. The first one should be 67.9% is a 2% increase, not the 71.9. Sorry about that, guys. We recognized this error earlier as a transposition. You go from 63.7 to 67.9 to 71.9. Next, we have a delay in retirement of 1 year. And that alone, not incorporating any increase in contributions, improves their situation by 4.3 percentage points to 68%. We delay by 2 years, that improves to 73% retirement replacement ratio. And lastly, if you do a combination of things, this 45-year-old, by increasing their contributions 4 percentage points and delaying retirement by 1 year to 68, gets them relatively close to the target income replacement ratio of 80%. We can go on and model many more situations, but I think this gives you an example of how might someone in their mid-40s dramatically improve their situation.
Michael, wouldn't be another way to say it is by giving a little bit now, you can take out a lot at the end. And it doesn't take big numbers now because we're going to have it in there for 30 years. You have to have some contribution, no matter what size. Every little bit helps is a mathematical truism.
That's correct. And for those of you may have heard this before from us at the RPB, we've always preached, quote unquote, the 18% or more total combined contribution. It is likely that this individual would have been retirement ready had they been contributing the full 18% for their full career. And now they're in a situation where they may need to do some catching up.
Michael, it may be of interest to know that in the work that you've done, the average age of the individual entering the revenue is 31.
It's like 30, it's actually
35,
a
sorry.
little bit older, a little bit older.
35, right.
All right, now we're going to take someone who is 58 years old, joined the RPB just a couple of years after the other person at 34, has a $1.2 million balance. This individual actually is contributing the 18% we talked about, but is only at 62.4%. Now what happens? The individual increases their contribution by 2 percentage points. You get a little bit of a bump from 62.4 to 63.7. Go to 4 percentage point increase, it grows to 64.9%. But now what happens, watch what happens when you start to delay retirement. By 1 year, grows to 67%. My eyes. 2 years, 77, and a combination of a 4% increase and a delay gets this individual to hit the 80% target. As you get older, I think that and you'll look at, once we look at the last scenario, you'll really see the impact of how these two individual decisions that you hopefully couldn't be in a position to make, you know, there's no guarantees, would impact your ability to retire with more money. Last situation, participant number 3, 64 years old, joined full career in the RPB, joined at age 30, has a $1.4 million balance. Currently contributing 13.4% and 0 for the employee. I think this probably speaks for itself as to why this individual may not be as retirement ready as they otherwise hope. Now, we skipped the 2 percentage point increase in contributions and jumped right to 4% because, as you can see, given they're 64 years old, retiring in 3 years at 67, even growing by 4 percentage points doesn't really move the needle that much, maybe one, little less than 1%. Delaying retirement, however, you can see has a much more material impact on this individual. 1 year, they go to 64.6. Now, delaying 3 years to 73.4%. If you delay 2 years, it's somewhere in between those two. And then if you look at a combined, increasing your contributions by 4% and delaying retirement by 3 years gets you to 75.1%. Again, not quite to 80%, but getting close. So this individual, and now you could really see, and we'll show this in the summary, increasing contributions has a much greater impact the earlier you do it, and that's why we always say save early and often. Delaying retirement and or lowering your income needs might be the most effective way to be able to get there for those who are in their mid-50s and beyond. And you can see the summary for the 45-year-old, the 56-year-old, and the 64-year-old. Pretty good improvements or projected improvements. And again, the model, you could look at 6% increase, you could look at delaying retirement by longer. I mean, there are many of your colleagues out there who have no plans to retire before 70 or even beyond. They just love what they do and they want to continue working. So those are really some of the things to consider. Now to summarize, we've already spoken about increasing contributions, delaying retirement, or maybe even postponing drawing Social Security if you can. Just one more word about Social Security. Full retirement age is 66. It's very rapidly approaching 67. For every year you delay after full retirement age, you get an 8% raise, and it does cap out. And that the same thing holds if you start to draw Social Security early. Early retirement, early Social Security is 62, but you get penalized quite substantially. So if you're hopefully in a position to not draw at 62, many of you will need to draw at 67, which is totally understandable. But if you delay, that is really your best bet at maximizing that cash flow for you. Now, for those of you who are retired, little bit of a different situation in that your choices are more limited. Obviously, you can consider reducing your retirement spending and thereby having a lower needed income replacement ratio. If you're in a position to reduce debt, which would help your cash flow situation. That's always an option. Of course, this is an option for both active and retired participants. And then the last thing, and this really affects everybody as well, David touched on it earlier, is review your asset allocation to see if you're invested appropriately based on long-term market projections. We were not able to model out to if you were more aggressive versus less aggressive. Suffice it to say, if you're very young with 30 plus years ahead, you should be invested in the market of course, as comfortable as you're willing to be, but not too conservatively in like the Capital Preservation Fund, where your chance of even maintaining rate pace with inflation could be challenged based on what's happening in the market. Lastly, I want to just mention something about feedback that we received from you, and this goes back to a 2016 survey that we did of all our participants. First of all, 65%, and this is important to understand, comparing those who are active versus retired. Only 65% of active participants were confident, this was again 2 years ago, that they're saving enough and invested appropriately. Look what happens, look at what the retirees said. 87% of the retired participants feel that they've saved enough and are invested appropriately, and 91% of them said they're able to live the retirement lifestyle they expected. So, you active folks out there, this is the message for you, that it's okay. At least this is what your colleagues are telling us. So there is hope for those of you who might feel a little less hopeful based on what's happening in the market these days. And or if you feel like you're not doing the things that we talked about in terms of contributing, right? Again, if you're young, contribute as much as you can. Review that asset allocation regardless of your age. And then, of course, as you're approaching retirement, there are some decisions that you'll need to make around when you might retire. Hopefully you have that choice. I was actually speaking with a participant recently who may not have much of a say in when they retire from their current position. Hopefully you have the choices. And of course, there are many other ways to supplement income, continuing to work part-time, taking on different careers, etc. Now, just to very briefly summarize and review our resources available, just want to do a little bit of a plug for our RPB's annual retirement planning seminar, which is scheduled for May 19th to the 21st of 2019 in San Francisco. This is a place where those who have attended really get a great benefit for digging in a little bit deeper than we're able to do in a 1-hour conference call today on both the financial aspects of retirement as well as the non-financial aspects of retirement. What does it mean to not, for example, if you're a rabbi, to be the rabbi any longer? We dive in deeply with some experts there. And on the financial side, we do dig a lot deeper on thinking about your income replacement ratio, thinking about your retirement budget, and you walk away with tools and techniques on how to think about those more. Of course, there are retirement planning calculators at rpb.org/calculators to play with and to model out what your situation might be. And then lastly, we have LifeWorks, which is a free resource to all participants. They are helpful in investment and planning, budgeting, debt management, all of the various financial topics that really go, quite frankly, beyond what we've talked about today. Just call them up, let them know you're with the RPB, and they'll assign a counselor to you and help you out. With that, I am thrilled to now turn it over to Len, who will read some questions that have been submitted by you.
I'm going to take this one a little out of order, and then we'll get right into the numbers. Without going through a bit of an introduction, the question basically becomes, they would like to invest in more environmentally and social conscious and social issues. How do we do that? We have the Reformed Jewish Value Investment Fund, which I commit your attention to. We've done a webinar on it. It's on our website. That might help you answer that question. It's set up for that. We can go into details later if you want, or Michael or Robert can definitely help you on that. But let's get into some questions regarding what we've been talking about here on a more direct basis. This is a couple that has, one is retired, and they have some outside investments. One is 61, this rabbi is 55. They want to know what their options are vis-a-vis their RPB account. They're obviously too young to touch their retirement funds or Social Security, and they want to know the longer we wait, the better it is for us. What are the options vis-a-vis the RPB account? Michael, why don't you take that one?
Sure. So all participants, whether they're active, what we call inactive, because it sounds like this individual is stepping down from their position, or retired, who are drawing money from the RPB account, get the full benefits of participating in the plan. Once you step down and you're no longer contributing, we continue to invest your money, we continue to service your account, answer questions you may have. You could participate, obviously, in today's webinar. You could participate in our retirement planning seminar. So for all intents and purposes, you're still one of us, and you can leave your money with us throughout the remainder of your life. There's no requirement to roll the money out at all.
David, here's one for you. This is a retiree, age 76, who says he's very happy to be in the RPB. He's curious about the kinds of steps the managers may take during a huge drop in the Dow Jones. I think let's call that the market overall, as occurred yesterday, and of course coming back today. Could you give his current investment profile is that he's 77%, pardon me, let me round this up, 78% in the appreciation and income fund and 22% in the capital preservation fund.
Thanks,
The question
Len.
Yes, sir.
First of all, the investment committee doesn't try and time the market. We recognize that markets go up and down. The Dow Jones was down 600 yesterday. As I speak, at this instant, it's up 500 points today. People who try and play that kind of volatility usually end up on the wrong side of the pendulum swings. So we don't do it. What we do try and do is adjust our asset allocation in light of the larger, longer-term trends. As I said when I was speaking about half an hour ago, we did take some money out of growth stocks and commit it to cash and to value stocks because we perceived that growth was overbought and value was oversold. In the long term, the best results come from the stock market, but in any particular time period, the stock market is going to be more volatile than fixed income. I would say for a 76-year-old, you're probably relatively highly committed to the stock market, certainly probably more than the average of your peers, and therefore you can expect a little bit more volatility. I think it's worth looking at your asset allocation.
There's an add-on question, David. He says that in the appreciation and income fund also includes the bonds and has the diversification helped his pension balance. You touched on it. Maybe you could expand a bit.
Yeah, the appreciation and income fund is basically the stock market plus shock absorbers. It reduces the volatility by using a big fixed income component, and that means that the ups and downs are not as violent. In the investment world, we speak of downside capture, which means that if the market falls 10%, how much of the 10% did our product capture? In the appreciation income fund, the downside capture might only be around 65 or 70% compared to the stock market. So it's a good way to reduce volatility at the expense of a more limited upside at the same time.
Another question, this individual's 10 years away from retirement and started his pension late, 40 years of age. Recently realized that haven't been making any contribution to my pension as the synagogue pays 100% of it. He's got some money on the outside and he could put it in now. Is it a priority to put as much of my own money in to max out the investment? Michael, why don't you take that one?
Well, I think that we may have just answered that in the last half an hour, which is simply yes. I think that if the later you start, the more you need to contribute to a retirement plan, the RPB, to try to catch up. Now, I will say it's got to come from your paycheck, though. We can't just take a check written out to RPB from you. It's got to go through your employer, and it's got to be a salary reduction or a reduction of your gross salary, like we showed you in that example during the presentation. So the answer is yes. Like I said earlier, save early and often. Now we're going to turn to some other questions.
This individual is thinking about how much to take from their pension. Are pension withdrawals tax deductible?
So the answer is yes, if you're a rabbi. Because the next question that actually asks for us to explain how parsonage works in retirement, which also addresses the next question: why was parsonage still shown for the person who is retired? So one of the great advantages of participating in the Reform Pension Board's retirement plan is that the parsonage that you're claiming can continue in retirement. We effectively become your employer and resolve parsonage on your behalf, but the distributions have to come from the RPB directly. So what that means is if you're a rabbi and you roll your money out of the plan to an IRA, you can no longer claim those distributions as parsonage. It's got to come from us. So to the degree that those distributions are part of your parsonage, so for example, if you have $50,000 of parsonage and you're taking $50,000 out a year, at the federal level, all else being equal, that is tax-free to you.
In this particular situation, an individual who is not a rabbi but gets the pension from the RPB due to in spite of the divorce. So in that situation, is it not similar in terms of salary? Obviously, there's a difference. The question is there a way for me to consult with an RPB representative for my circumstance? I've yet to contribute anything on my own and don't even know if I can. Michael? So
absolutely happy for this individual to contact our office, Robert Perry, rperry@rpb.org. If you send him an email, he'll be happy to speak with you. But just so you understand, we can't take additional contributions from people who are not working for an eligible employer. 99% of those eligible employers are URJ synagogues. So this individual who is not a rabbi, I guess who's the ex-spouse of a rabbi, you can maintain your account with us and take distributions to whatever degree you'd like. You just can't make direct contributions to your account. Okay, next question.
Is the most one can contribute still 3% and the congregation 15% for a total of 18? I think we hit on some of it, but maybe we could be a little bit more specific, Michael.
Sure. So it's a little bit of a misnomer about the 3% and the 15%. And this is what we're really hoping. At a minimum, your employers are contributing on your behalf. Of course, that's the 15%. And that you're contributing a minimum of 3% for a total of 18. The maximum that you can contribute from your paycheck via salary reduction, if you're under 50, is $18,500 for 2018. And if you're 50 or over, you can actually contribute an additional $6,000. So for a total of $24,500. The combined limit, and that's only for the IRS portion, because many of you don't realize we have the ability to take money that exceeds the IRS limits, and that money goes into what's known as the Rabbi Trust. So at the end of the day, there really is no maximum total amount that can be contributed to the RPB. We have the investment vehicles and the plan, both the RPB's 403B and the RPB's Rabbi Trust, to accept any amount of money.
Okay.
Next question.
All right. Individuals have been in the RPB for a year. If I leave in a few years for other work, do I need to take the money out?
We might have touched upon that, but the answer is no. You can leave the money with us. If you leave, hopefully you come back, but the money is yours to stay in the plan for as long as you'd like.
What is the mechanics of withdrawing from the RPB account upon retirement, and how does it work?
So when you retire and are looking to start taking what hopefully will be regular monthly distributions, because at the end of the day, the RPB becomes your employer for sending out, hopefully regular monthly paychecks, if you will. All you really need to do is contact the office. Again, Robert Perry at rperry@rpb.org. Send him a note, say, hey, I'm looking to retire. Within a few weeks, he could set you up with a regular monthly distribution, which is really one of a few options you have, but that's the most commonly one used.
All right. Many of you know that one of the enhancements we put in was a Roth 403B plan. Rabbi Marcel, can you address the new Roth plan?
Sure. So yes, we launched the Roth 403B back in the spring. I think it was in May. And effectively, Roth 403B enables you to contribute post-tax money into and invest it alongside your other money. And when you retire and start taking distributions, that money is tax-free. Whereas distributions from your 403B account, your regular 403B account, are taxable to the extent that if you're a rabbi, you don't have parsonage. Roth 403B for rabbis, it gets a little tricky to figure out whether it makes sense to put money in post-tax because of the parsonage benefit. What I would recommend is you really speak with your tax advisor or accountant to help you think through what might make the most sense for you.
Can you address how taxes work at retirement? In my planning, how much will my tax rate go down since I won't be paying Social Security or FICA taxes?
So yes, it is true that when you retire, you won't be paying Social Security tax or Medicare tax. As far as your effective tax rate at the federal and state level, that is really very dependent on what your overall taxable income situation is. There's really no way to say this is how it will work. In the example we used earlier in the presentation, we just, based on the numbers we showed, assuming that we did, if you noticed on the assumptions, we did not consider deductions or exclusions or anything else. We wanted to kind of keep it simple, that we calculated the federal tax rate. The state taxes get really even much more tricky because depending upon what state you live in Florida, there is no state income tax. You live in New York or California, there's a really high state income tax. And those rates really will affect what your situation is. So unfortunately, there's no simple answer other than, yes, for sure, you're not going to pay Social Security taxes when you are no longer working.
By the way, as a person who goes to Florida for 6 months out of the year, I can assure you that many retirees who have smicha do come to Florida, and I can assure you that I'm sure this is part of their thinking. Plus, it's nice weather. My small congregation contributes nothing to my RPB or any retirement account. What can I do besides send in my own contributions?
I'm not sure how to answer that one, Len. As far as contributing and participating in the RPB, I'm hoping that you are able to contribute. We're hoping you can contribute something. But it all depends on your situation. If you can't get your employer to contribute, hopefully you can start contributing from your paycheck if your own cash flow allows. There really isn't much more you can do. I mean, hopefully you're able to maybe talk with your employer and maybe they don't reason with them, but we do certainly recognize, and certainly in small congregational situations where budgets are more limited, that it gets a little bit more tricky. Sorry, I can't give you more direction.
Michael, on, let me try and phrase the question a little differently. We're noticing some rabbis have contracts, to which it's an all-inclusive, and is looking for the particular rabbi to carve out part of that contract for the pension. Who has to pay that, the congregation or the rabbi?
Well, that's really dependent on the contract. I mean,
Well, we could take a rabbi contribution.
those individuals, typically those individuals who are on, let's say, packages, right?
I meant packages.
Contribute, ask their congregation to contribute a percentage. We see many who are contributing 15%, some are contributing 18%. Then, of course, that often means we're also seeing that the employee is contributing zero, because they've decided to let the employer send in all the money. So that's typically what we see. This individual, we obviously don't know what their situation is, so it's hard to say based on whether they have a package arrangement or they're simply, for example, an educator working in a small congregation who unfortunately isn't able to get their employer to contribute. So it's really hard to say.
I see it's 3 o'clock. David, we will let you control the market. Michael, you can control the administrative aspect of it. Stephanie will keep pumping out materials for you, and I intend to to go home. So I really want to thank you all for participating. We're going to try and set up our webinar so we have more content throughout the year affecting you directly. We hope it's been interested in your feedback. Thank you very much, and hope everybody has a safe day. And vote, as we say in New Jersey, often. Thank you very much.
Thank you, everyone.